Listen very carefully to what I'm about to tell you. Right now, as I'm recording this on Tuesday, April 28th, 2026, silver is trading at $75.67 per ounce. Tomorrow at 2:00 p.m. Eastern Time, Jerome Powell will walk into his final Federal Reserve press conference as chairman. The entire financial world is waiting to hear what he says about interest rates, inflation, and the economy. But here's what almost nobody is talking about. Wall Street has already made its bet, and they're not betting on what Powell says. They're betting against it. I spent the last 6 hours analyzing options data from the CME, tracking institutional positioning in silver futures, and cross-referencing it with Treasury bond movements. What I found is shocking. The big money, the hedge funds, the institutional traders, the people who move billions of dollars at a time, they are positioned for Jerome Powell's words to be completely irrelevant within 48 hours. Let me show you exactly what they know that you don't. The silver spot price right now is $75.67. That's down from $80 just 10 days ago on April 17th. In exactly 10 trading days, silver has dropped $11. That's a 13% crash in 2 weeks. But here's the part that makes no sense to most people. During those same 10 days, the US dollar index strengthened, Treasury yields stayed elevated near 4.27%, and inflation expectations actually increased. The University of Michigan just confirmed consumer inflation expectations at 4.8% for the next year. That's the highest reading in years. So explain this to me. If inflation expectations are rising, why is silver, the inflation hedge, dropping like a stone? The answer is what Wall Street already knows. Tomorrow's FOMC meeting is not about what Powell says. It's about what happens Thursday morning at 8:30 a.m. when the Q1 GDP number hits. And the institutional money has already seen the warning signs that retail investors are completely missing. Let me give you the single most important piece of economic data that came out in the last 72 hours. The final revision for Q4 2020 of GDP was released 2 weeks ago. The initial estimate back in January said the economy grew at 1.4% in the fourth quarter of 2025. That number has now been revised down to 0.5%. Let me repeat that. The Q4 economy didn't grow at 1.4%. It grew at 0.5%. That is a 64% downward revision from the original estimate. The economy was 3 times weaker than the government initially reported. Now here's why that matters for Thursday. The Q1 2026 GDP advance estimate is scheduled to release Thursday morning. The consensus forecast from economists is 1.8% growth. But if the Q4 number was revised down by 64%, what makes you think the Q1 number is going to hold? The Kraken blog specifically highlighted this in their April 27th analysis. Q4 2025 GDP was revised down to just 0.0% on the third estimate from 1.4% at the advanced stage. A significant deterioration that only became clear in retrospect. They're telling you in plain English, the first GDP estimate is always wrong. It gets revised down massively later. So if Thursday's GDP comes in at 1.8%, the real number could end up being 0.6% or 0.7% by the time the final revision comes out in June. And if Thursday's number misses and comes in at 1.0% or lower, then you're looking at 2 consecutive quarters of near zero growth. That's the technical definition of economic stagnation, not a recession. Stagnation. And stagnation with 3.3% CPI inflation is called stagflation. Now, let me show you the options data that proves Wall Street already knows this. The CME FedWatch tool tracks the probability of Federal Reserve rate changes based on Fed funds futures pricing. 3 weeks ago, on April 7th, the market was pricing in a 22% chance of one rate cut before the end of 2026. As of this morning, April 28th, the probability has dropped to 0, not 5%, not 2%. 0%. But here's where it gets interesting. The market has now pushed out the expectation for the first rate cut all the way to mid-2027, that is 15 months from now. FX Street reported this yesterday. CME FedWatch latest Fed rate probability points at no rate cut until mid-2027. That is the single largest shift in monetary policy expectations in the entire year. In 3 weeks, Wall Street went from pricing in one possible cut in 2026 to pricing in 0 cuts for the next 15 months. That doesn't happen unless institutional traders have information or models that tell them inflation is going to stay elevated far longer than the Federal Reserve is publicly admitting. But here's the contradiction that exposes the whole game. If Wall Street believes rates are staying higher for longer, that should be bearish for silver in the short term. Non-yielding assets like silver and gold struggle when interest rates are high because you're giving up yield to hold them, and that's exactly what we've seen. Silver down from $84 to $75.67 in 10 days. The dollar is strong, rates are high, silver is weak. That's the surface story. But underneath, the institutional positioning tells a completely different story. Let me give you 3 data points that don't make sense unless you understand what's really happening. Data point 1, COMEX registered silver inventory is now at 76.88 million ounces. That's down 64% from where it was in 2020 when it was 240 million ounces. The open interest in silver futures is 575 million ounces. That means the paper to physical ratio is 7.5 to 1. For every ounce of actual silver sitting in the COMEX vault, there are 7.5 ounces of paper contracts claiming ownership of it. The coverage ratio is 13.4%. That is the 6th consecutive month where COMEX coverage has been in stress territory. Data point 2, the Shanghai Gold Exchange is pricing silver at approximately $88 to $90 per ounce right now. That's a $15 premium over the COMEX spot price of $75.67. That's a 20% premium. Physical silver in Asia is trading 20% higher than paper silver in New York. That spread has been widening for 3 weeks straight. Data point 3, China imported 106.76 metric tons of silver in January and February of 2026 combined. That is the highest 2-month import total in 8 years. Finance magnates confirmed this on April 26th. China is buying physical silver at an 8-year record pace while the COMEX paper price is collapsing. So let me connect the dots for you. Wall Street knows the GDP number Thursday is going to be weak. They know Powell can't cut rates because inflation is still at 3.3% and consumer expectations are at 4.8%. They know the Federal Reserve is stuck, and they know that sticking the Fed in a high-rate, low-growth, high-inflation trap is the exact recipe that caused silver to go from $6 to $50 in 1979 and 1980 during the last major stagflation cycle. But they can't buy silver at 84. That's too expensive if there's any chance the GDP number Thursday is strong and the narrative shifts back to a soft landing. So what do? They sell paper silver on the COMEX to drive the price down to $75, and then they quietly accumulate physical silver in Shanghai, London, and Singapore at the cheaper paper price. The $15 Shanghai premium is not random. It's proof that physical buyers are paying above paper pricing because they know the paper pricing is temporary and manipulated. Let me show you another piece of proof. On January 30th, 2026, silver was trading at $91 per ounce in the morning. That afternoon, President Morgan announced the nomination of Kevin Warsh as the next Federal Reserve Chairman. Within 6 hours, silver crashed from $91 to $71, a $20 drop in one trading session. CNBC reported that margin calls were triggered across the entire precious metals market. Traders who were leveraged had to sell immediately to cover their positions. It was forced liquidation, not organic selling. Here's the quote from CNBC on January 30th. "This is getting crazy," said Matt Maley, equity strategist at Miller Tabak. "Most of this is probably forced selling. This has been the hottest asset for day traders and other short-term traders recently. So there's been some leverage built up in silver. With the huge decline today, the margin calls went out. So they crashed silver by announcing a hawkish Fed chair nominee. The same pattern happened in early April when Iran peace talks were rumored to be progressing. Silver dropped from $80 to $75 in 3 days. Every time there's a narrative that could be bearish for silver, the paper market sells it down aggressively. But the physical market doesn't follow. The Shanghai premium stays elevated. The COMEX registered inventory keeps draining. The imports into China keep hitting records. Now let's talk about tomorrow. Jerome Powell's final press conference as Fed chair starts at 2:30 p.m. Eastern Time, 30 minutes after the rate decision is announced at 2 p.m. Everyone knows the rate decision is a hold. The CME probability is 99.5% for no change. So the rate decision itself is irrelevant. What matters is what Powell says in the press conference. Here's what the market is watching for. If Powell says anything that sounds dovish, anything about monitoring both inflation and employment equally, anything about rate cuts remaining on the table for later in 2026, anything about energy-driven inflation being transitory, silver will spike. The Kiplinger analysis from April 27th estimated that dovish language from Powell could move silver $4 to $8 higher within 30 minutes. That would put silver back at $79 to $83 by Thursday morning. But if Powell says anything hawkish, if he emphasizes that inflation is still the primary concern, if he says rate cuts are not appropriate in 2026, if he suggests the Fed would not hesitate to raise rates if inflation reaccelerates, silver could drop $3 to $6. That would put silver at $72 to $69, dangerously close to the $70 floor that has been tested 3 times this year. Here's why I think Wall Street is betting against Powell's words mattering. Even if Powell sounds dovish tomorrow, the GDP number Thursday morning will override it. If GDP comes in weak at 1.0% or lower, the narrative shifts immediately to stagflation, regardless of what Powell said 24 hours earlier. And if GDP comes in strong at 2.0% or higher, then Powell's dovish tone gets dismissed as outdated because the data shows the economy is fine and the Fed doesn't need to cut. So Powell's words are a 24-hour event at most. The GDP number is a multi-week event, and the options market is pricing that in right now. Look at the volume in silver call options for May expiration. The highest concentration of call buying is at the $80 and $85 strike prices. That tells you traders are positioning for a short-term spike after Powell's presser tomorrow. But the put options for June and July expiration show heavy volume at the $70 and $65 strikes. That tells you the same traders are hedging for a larger move down after the GDP data comes out. They're playing both sides because they don't trust Powell's words to hold up against economic data. That's the bet. Powell talks, silver moves up for a day. GDP prints, silver moves down for a month. And in the middle of all of that, institutional money is accumulating physical metal in Asia, while retail investors panic sell paper contracts in New York. Let me give you the U.S. military stockpile angle because almost nobody is covering this. Fortune reported this week that the U.S. military has used up approximately half of its most expensive precision-guided missiles during the Iran conflict. Tomahawk cruise missiles, JASSM extended-range missiles, and bunker-buster munitions all contain significant amounts of silver in their guidance systems, circuit boards, and radar components. Rebuilding half of the U.S. missile arsenal is going to require an emergency procurement cycle over the next 4 years. The Congressional Budget Office hasn't even factored this into their defense spending forecasts yet, because the depletion only became clear in the last 30 days. That is a structural new source of silver demand that is completely absent from every analyst model. When defense contractors start ordering the components to rebuild missile stockpiles, they're going to be pulling silver from the same global supply chain that's already running a 46 million ounce deficit in 2026. And speaking of defense, let me tie this into the Magnificent Seven earnings that are coming tomorrow night. Microsoft, Alphabet, Meta, and Amazon all report earnings after the market closes tomorrow. These four companies alone are spending $670 billion on AI infrastructure in 2026. Microsoft's Azure cloud grew 37% last quarter. Alphabet just announced they're doubling their 2025 CapEx levels. Meta is planning to spend nearly double what they spent in 2025. Amazon's AWS is expanding data center capacity in 6 new regions this year. Every single dollar of AI CapEx goes into servers, cooling systems, power distribution, and networking hardware. All of that hardware uses silver. Circuit boards, thermal interface materials, connectors, and switches all require silver because of its unmatched electrical and thermal conductivity. The AI build-out is one of the largest industrial silver demand drivers in modern history, and it's happening at the exact same time that global mining output is flat and COMEX inventories are draining. If all 4 CEOs tomorrow night reaffirm their AI spending plans and guidance shows no slowdown, that $670 billion figure could go to $750 billion by the end of the year. At an estimated 0.5 to 1 gram of silver per $1,000 of AI infrastructure spend, you're talking about 300,000 to 750,000 additional ounces of silver demand just from AI in 2026. That demand is not in any of the current silver deficit forecasts. But here's the risk. If any of the Mag 7 companies cuts AI CapEx guidance tomorrow night, that weakens the industrial demand story for silver. Netflix missed earnings 2 weeks ago and dropped 10% in one session. If Microsoft or Amazon signals any slowdown in AI monetization or spending, silver's AI narrative takes a hit. Watch the guidance specifically, not just the quarterly results. Now let me address the elephant in the room, the $70 floor. Silver tested $70 3 times in 2026, February 14th, March 9th, and March 28th. Every single time, physical buyers stepped in and pushed the price back up. The lowest intraday print was $69.80 on March 9th. It didn't hold below $70 for more than 4 hours. Right now, silver is at $75.67. That's $5.67 above the floor. If Powell's press conference tomorrow is more hawkish than expected, or if the GDP number Thursday is stronger than expected, and the market interprets that as the Fed can stay higher for longer without breaking the economy, silver could test $70 again. The technical analysts are watching this level closely. Finance magnates published a bear case chart on April 26th, showing the breakdown levels below $70. The next support is the 200-day exponential moving average at $65. Below that is the October 2025 breakout level at $54.50. I'm not saying silver is going to $54. I'm saying that if $70 breaks, the next technical level where buyers are likely to step in is $65. And that's a $10 drop from where we are right now. For anyone holding leveraged paper positions or short-term call options, that's a wipeout scenario. But here's the other side of that trade. If $70 holds again, it confirms a quadruple bottom. A quadruple bottom on a commodity that's in a structural supply deficit, with central banks buying gold for 23 consecutive months, with China importing at an 8-year high, and with AI infrastructure demand ramping, is one of the most bullish technical setups you can get. A confirmed bottom at $70 with a catalyst like weak GDP on Thursday could send silver to $85 or $90 by mid-May. Let me give you the institutional forecast data because this is where it gets absurd. Reuters polled 30 professional silver analysts earlier this week. The median forecast for silver's average price in 2026 is $79.50 per ounce. Silver is currently trading at $75.67. That means silver is $4 below the consensus average forecast from 30 analysts who study this market for a living. JP Morgan's forecast is $81 average for 2026. That's the most conservative major bank estimate. Silver is $5 below JP Morgan's number. Bank of America has a bull case range of $135 to $390 for 2026. Let me repeat that. Bank of America's precious metals team published a scenario where silver could go as high as $309 per ounce this year. The current price is $75.67. That's a $230 gap between the high-end bull case and the actual market price. I don't know if silver is going to $309. What I do know is that when every single major institutional forecast is above the current price and the current price is dropping, something is broken. Either every analyst is wrong or the paper market is being manipulated lower to create an entry point before the next leg up. Given the physical shortage signals from Shanghai, the COMEX inventory drain, and the record Chinese imports, I'm betting the analysts are closer to reality than the paper price. Here's what I'm watching in the next 48 hours. Tomorrow at 2:30 p.m., Powell speaks. I'm watching for any mention of data-dependent, both mandates, or transitory inflation. Those are the dovish code words. If he uses any of them, silver spikes into the close tomorrow. Thursday at 8:30 a.m., GDP and core PCE release simultaneously. If GDP is below 1.5% and PCE is above 0.3% month over month, that's the stagflation confirmation. Silver will have an immediate $5 to $10 move in one direction or the other within the first hour of trading. And Friday, May the 2nd, is the biggest risk day of the month. That's the April non-farm payrolls report and the COMEX May 1st notice day happening on the same morning. If the jobs report shows weakness and COMEX delivery stress shows up simultaneously, you could see a short squeeze in silver that makes January's move from $71 to $121 look small. The last thing I'll say is this. Wall Street's bet against Powell's words is not a bet against silver long term. It's a bet that short-term narratives don't matter when the structural fundamentals are this broken. Rates can stay high, the dollar can stay strong, and Powell can sound as hawkish as he wants. None of that changes the fact that the world mined 830 million ounces of silver in 2025 and consumed 876 million ounces. That's a 46 million ounce deficit. Multiply that over 6 consecutive years, and you've drained 762 million ounces from global inventories. That's an entire year of global mine production that's just gone. So when I see silver at $75.67 with a $90 Shanghai price, a 13.4% COMEX coverage ratio, and every institutional forecast above $79, I don't see a bear market. I see the last clearance sale before the market reprices reality. Powell's words tomorrow are noise. The GDP number Thursday is signal, and the physical shortage is the trade. That's the Tuesday, April 28th, 2026 Silver Intelligence Brief. Powell speaks in less than 24 hours. Position accordingly.